Now, I think everybody is aware of the coming interest rate rises. And one thing that I have been hearing in a lot of my strategy sessions and from a number of our clients recently is, can I identify positive cash flow investment properties in Brisbane right now? So myself and Crystal are going to talk to exactly how you can generate positive cash flow in the current market so that you can hedge against those coming interest rate rises. Now, I've dragged my sister Crystal into the booth this morning to talk a little bit about positive cash flow properties. Now, Crystal is our head buyer's agent at Pumped On Property. She herself has helped our clients purchase over $100 or $150 million worth of real estate over the last 6 years. She's an absolute gun when it comes to identifying value opportunities, negotiating with the real estate agents, and helping our clients execute their specific property investment strategy. So Chris, obviously it's been a wild 2021 and we've seen some pretty strong capital gains. And what I've sort of noticed is those opportunities to get a positive cash flow property have become pretty difficult, hasn't it?
Yeah, definitely. So with the growth that we've seen in the last 12 months, property prices have gone pretty nuts. So it's pretty hard to imagine that you're just going to get a single income home that's immediately cash flow positive. I think the Brisbane average at this point in time for rental yield is sitting at about 3.8% for a single income property. So that price growth has occurred and rents quite haven't caught up yet. So looking at ways that you can do a positive cash flow strategy, you're going to have to manufacture it yourself.
Yeah, and generally that does happen when we start to see a market move through its growth cycle. Generally, the first thing to happen is those property values rise and it takes a little while for those rents to catch up. Now, 3.8% rental yield is pretty strong in comparison to, say, Sydney or Melbourne. So Brisbane still does have some quite solid rental yields. And I'm seeing in the current market, you've been able to generate, 3.5 to 4% rental yields quite consistently for a number of our clients. Now, there is some indication that we are in a bit of a rental crisis around Australia right now, with the vacancy rates, according to SQM, sitting at 2.1% Australia-wide. Now, up here in Brisbane at the moment, they're sitting at 1.1% according to SQM. So it's chronically undersupplied. And what that will do is put some short-term pressure on those rental prices. And the CBA believe that we could see an increase by $100 per week of rental incomes this year in 2022, but only time will tell there. Hopefully we start to see a little bit more supply come to the market, and that's what I really want to spend a bit of time talking about today, because the reality is, guys, if you just want to purchase a stock standard house in the Brisbane market, it is highly unlikely that you are going to be able to generate positive cash flow. So the way that we can do it is actually getting our hands dirty, incorporating a bit more of an active strategy, and manufacturing our cash flow. Now, you've helped a number of our clients execute this strategy. We call it the house and granny flat strategy, the dual income strategy. So take me through that. Are there options in Brisbane to execute this dual income strategy? Where can you do it? What do those numbers look like roughly?
Yeah, of course. So blanket wide across Brisbane, there's like 4 or 5 different council areas. So there's only about 2 council areas that do allow a dual income strategy right now in Brisbane, or at least that secondary dwelling by way of a granny flat. So there's 2 council areas that we identify right now that we're doing that in. Just south of Brisbane, you've got the Logan council area. They will allow granny flats, but they're still trying to counteract them being built too commonly. So they have some pretty strict guidelines around what you can and can't do, where you can and can't build them. But if you were to buy a property that had granny flat potential right now, we're looking at homes between about $600,000 and $650,000 dollars to purchase. And then with the rate of building going up in the last sort of 12 months as well, granny flats to build in that area are looking between about $200,000 and $220,000 to actually execute. So all in, you're in there for about $850,000 to $880,000, give or take. And that's in South Brisbane. The house itself, the type of property you're going to be buying for around that $600 to $650 price point, is going to be renting for anywhere between about $450 and $500 per week. And pretty consistently, the granny flats are getting about $350 right now. These numbers may or may not change over the next 12 months if rents do start to shift and that sort of thing. But with vacancy rates as low as they are, there is a real need for that affordable housing. So these granny flats are filling a really big gap in the market for a lot of tenants because there's not much out there under about $450, $500 per week rental rise right now, especially nothing that's near brand new. So these brand new granny flats are filling a really big gap in the market and people are just eating them up.
Yeah, I've seen these things rent out so quickly. We were talking to our property manager the other day and he said that he hosted an open for inspection for a 2-bedroom granny flat down in Logan. He had 23 groups come through and rented it out north of $350 per week as well. So they're hot property in the market at the moment. But as Crystal said, there is some very strict requirements that you need to meet down there in the Logan City Council. What we do is we always just talk with a town planner. Now, generally, you have to pay a small fee for a town planning report, but that will actually give you the clarity that you can actually build and lease a granny flat out completely separately there. Now, we've just identified a new pocket of the Brisbane market that we actually really like on paper, looks really interesting, down out in southwest West Brisbane in the IPSWICH City Council where they actually enable you to do this as well. But once again, is quite tricky. Now, the strategy out there is exactly the same. You need to buy a piece of land that meets the requirements. Out there, you're finding a little bit more affordable properties, right? Probably around the $500,000 to $600,000 range. Granny flats costing similar amount, $200,000 to $220,000.
Yeah, the IPSWICH Council area is really, really interesting. So the rental yields look a little bit stronger than as you get closer to the city or closer to Brisbane. You're looking at, for a $500,000 to $550,000 property, like a $420,000 to $450,000 or $460,000 rental return. And then IPSWICH Council only allows 1-bedroom granny flats. So they're looking to rent between about $300 and $350 per week, whereas the Logan Council does allow the 2-bedroom granny flats that do rent that little bit stronger.
Love that. Now, there's the third option, which is my personal strategy, and I really like this option as well, which is sort of the knockdown rebuild strategy. And this one typically can be a little bit easier to execute, definitely more expensive, but a little bit easier because, with the existing house that's already on that block of land, you don't need it to enable the granny flat in the backyard, because what you would essentially do is purchase a quite run-down home on a nice piece of land in a quality street. And then what you would do is essentially bulldoze that house. Those costs vary depending on the type of home that you are knocking down. We're seeing between sort of $25,000 and $30,000 depending on the house. And, with that, then you can sort of rebuild a brand new dual income home.
Yeah.
So I like to call this sort of the worst house on the best street to the best house in the best street type of strategy. Now, that's subjective. It may not be the best street, but at the same time, you can kind of purpose build that home. You could do a 3-bedroom, 2-bathroom with a separate 2-bedroom, 1-bathroom granny flat, or a 4-bedroom, 2-bathroom with a separate 2-bedroom, 1-bathroom granny flat. And I really like that option because then you've obviously got a really beautiful brand new home. You have the amazing depreciation benefits from it. You can purpose build that and design it for the specific tenants that will be renting that property as well. So I really like the options, but like every strategy, there's always trade-offs. There's always pros and cons associated with an investment strategy like this. So let's jump into some of the different pros and cons associated with this dual income positive cash flow strategy.
So a really big positive with this strategy is obviously the multiple incomes is what is going to create that positive cash flow. So that checks that first box in terms of why you would actually implement this strategy. It's a really low risk investment option because despite what the market does around you, you've got that really strong income coming from your investment property. And like you said at the start, sort of it offsets those interest rate rises and things like that, which is why a lot of people are looking to implement this right now to kind of protect that downside risk that may come with market ebbs and flows.
And with those multiple incomes, it actually reduces your risk a little bit because if somebody stops paying their rent or moves out of the property, it reduces your vacancy periods, and at least you've still got some cash flow coming into the property as well. So the more incomes, the better always. And yes, of course, that positive cash flow. But some of the other things that I really like about it is just the fact that you get some pretty solid depreciation benefits as well, which can help that cash flow as well. And then the cool thing about this strategy as well is you can still generate that long-term capital growth. Because you are focusing on a dual strategy here, it is focusing on a long-term capital growth strategy, but then manufacturing that positive cash flow as well. And, you know, we've had a client that essentially did this down in Sydney, where he bought properties a long time ago, 15, 20 years ago. He then built granny flats. He's had the multiple incomes for that entire period of time. He's had that positive cash flow for that entire period of time, which has helped him pay down the debt really quickly. But he says that the value of the property has actually stayed in alignment with similar properties in the market as well. So that indicates that it doesn't have a huge impact on that longer term capital growth. And for me, I'm always trying to get the best return on my investment. I'm always trying to look at ways where I can implement multiple strategies into the one purchase, because it just lowers my risk. It gives me multiple options, and it just makes me a little bit excited as well. But there's always two sides to every coin, right? And there is certainly some cons associated with building granny flats or doing knockdown rebuild strategy. I think the two biggest ones to me is just the fact that it is a very active strategy. You need to do the work. It's a lot more challenging to find those assets, and you need to be in a specific council region. You need to have specific requirements to be allowed to build that granny flat and rent it out separately, which makes it quite challenging to find that type of asset, and it is quite expensive as well. You know, we're talking about a total project cost north of $800,000. That is quite an expensive project to execute.
It's another thing that I guess is a little bit of a con with the granny flat strategy is you're restricted with those council areas, like we touched on earlier, in terms of there's really only two parts of Southeast Queensland or the Brisbane market that are allowing it right now. So it does make it really hard to kind of find. They are, I guess, open to the idea of allowing them to happen, but they're still pretty strict on their criteria within those suburbs. So it does, just make it, I guess, a little bit more challenging from that aspect. And when it comes to resale, not everyone wants to buy a dual income home. So you are wiping out a percentage of your resale market, because those sort of emotional owner occupiers that want a family home, they want the big backyards and that sort of thing. When you're putting a granny flat in a property, you're taking away that backyard space. When you're building a brand new dual income home, you're often taking up a lot of the yard or the land that you're working with. So you are, I guess, wiping out a little bit of the market there when it comes to resale.
For sure. But I think, you know, there's positives and negatives to everything in life. That's the reality, right? That's the duality of life. There's always going to be positives and negatives. But the good thing is that there is still positive cash flow investment strategies that we can implement in Australia's third largest capital city that is in its rising stage of the real estate cycle at the moment, according to HTW. So I really like it for those people that are wanting to generate a little bit more cash flow, that are willing to implement a bit more of an active strategy, that want to, you know, hedge themselves against those coming interest rate rises as well. Now, if this strategy is something that is of interest to you and you'd like to discuss it a little bit further, then we'd love to offer you a free one-on-one strategy session with myself, Simon, my brother Ben, or one of the colleagues at Pumped On Property. So please head over to our website, www.pumpedonproperty.com, and follow the links to book in your free strategy session, where we'll talk about exactly where you're at right now, where you want to be in the future. We'll share some information about this strategy and about the Brisbane market, and then you can take that information and go and absolutely crush it yourself, or you could become one of the small number of clients that we work with each month, and we can hold your hand through that process. Either way, we wish you the absolute best of luck. Thank you so much for listening, and as always, invest safely.
Whew,
That's a wrap.
That's a wrap.
Getting cool,
bro.
Yeah. Oh, sweaty. So sweaty. Oh, that's good. Look at that.
So nice, eh?
Oh.